This is my favorite topic. We have been writing a lot about digital lending. In fact, we wrote positive, negative sides, and I still remember I wrote a piece called "Buy Now, Don't Pay Later," and received number of page views on that particular article. So I have a couple of thoughts here, but the topic specifically is about whether the digital lending for NBFCs is a biggest boon for the NBFCs and fintech companies. And I would like all of you to share your opening remarks perspective on the same topic. Before that, we just want to tell you that we're supposed to have one more speaker, Shaili Kajaria, but unfortunately she's not feeling well, so she could not travel. She had to cancel the ticket. In fact, she just spoke to me last night. So we don't have Shaili here. But the other panelists, and I will start with Anil first, and then we'll take this round. So the question is digital lending the biggest boon for NBFCs?
Thanks, Amol, for having me here. Appreciate it. And I was just telling Amol a little while earlier, this is nice to be in a town like Chennai, where there seems to be a lot more interest and participation than when we do these events in Mumbai, where there are quite thin crowds. So thanks for having me here. On the question of is digital lending the biggest boon for NBFCs, I think digital lending is biggest boon for all lenders, right? Like that has become the growth engine for lending as a whole. And if you look at unsecured personal lending, which is where NBFCs majorly operate, um, or even unsecured lending as a whole, personal or business, obviously that's the area that kind of lends itself most easily to the digital lending piece. Because when you are doing an onboarding process and are issuing a loan to a consumer, and does not have elements like lien perfection or title registration, which is what you required in secured lending, then obviously digital kind of lends itself to that model. And a lot of growth that has happened in India in this last 12 months, especially post COVID, if you look at the loan balances, have all increased mainly in the unsecured lending piece, be it credit cards or personal unsecured lending or business unsecured lending. And it has been across the board, right? It has been across the board, NBFCs, fintechs with their lending partnerships. And these partnerships are with banks and NBFCs, and banks themselves are all digital lenders today. No one is or today originating an entirely branch-based lending process. Obviously, that exists, but more and more banks are also involved in digital lending. So, digital lending has been a boon for all of us, mainly because it has improved reach, improved efficiency, and improved speed.
Sure. Prashant, can I take your view?
Yeah, so I think I agree with Anil in many ways because if you look at how the market is shaping, I think one behaviorally everyone is becoming digital first, and I think consumer behavior also has largely shaped. So if you look at, I think there's going to be a significant increase in the target market itself in terms of the lendability. You're going to have a lot of people from tier 3, tier 4 come into it because I think there are a couple of factors that are working towards it. So I think the ticket sizes have reduced. Largely, if you look at it, 5 years ago, 31% of the loans that were given were less than 1 lakh. Now it's almost 80%, right? So you're seeing a significant shrinkage in terms of the size of the ticket of the loan itself. And obviously when that happens, you need more digital means to be able to provide for that and collect and all of that. So the cost of that. The second aspect is the tenor. So, I think the average age, and a simple thing by which I look at it is, my father, for example, took 3 loans. He took a home loan, he took an education loan for me, and then I think a personal loan at the time of the wedding, right? In his entire lifetime, there were 3 loans. The average age of Jakarta today in our office is around 27, 28 years old. And most of them have already taken 3 or 4 loans of the smaller ticket size already. So I think in that lifetime, these people will end up taking anywhere between 10 to 15 loans in that sense. So you have the market expanding, so all of these leads to a larger segment which will come in, the blue collar segment, the tier 3, tier 4. And all of this will only be possible if it is digital. and you're able to provide technology and systems to be able to process all of this and make this happen almost instantaneously. So in that sense, I think digital is definitely a boom. You're going to see a lot of more people getting credit and coming into this system. And I think it's the way to go in that sense.
Yeah, sure. So Anil and Prashant agrees that digital lending is a boon, and I'm sure Banisha and Saporna will also agree to that fact. So I want both of you to add a little bit. One is obviously digital lending is a boon or not, and more importantly, if it's a boon, why it is a boon.
Yeah, so definitely in the right direction. And I would like to see, I actually see it as half glass full. Because while we've gotten to a point where, there's a lot of reach and accessibility, I think there's a lot that needs to be done also. But in general, right, digital lending, what it has provided is instant dispersal. So, a consumer really doesn't have to leave, where if he's working somewhere or doing something, instant dispersal, instant loan dispersal. The second is digital collections. So we've gotten to the point where, it doesn't have to be where you're sending someone for collections, right? There are various means that you could build using digital and data to be able to sort of nudge the customer, warn the customer, engage with the customer. There are algorithms that are built to make sure that the customer is going to go delinquent. So digital collections is seen actually as tremendous, we don't talk about that a lot, but it's seen as tremendous progress when it comes to, from dispersal plus collections. I think the third is, ability to run your business in a more efficient manner. And when you're able to run your business in a more efficient manner, what really happens is you land up giving that spread, or at least you have the ability to give that spread back to the customer. So I think all in all, if you sort of combine all of these, definitely moving in the right direction.
Sure. So again, Amal, to your question around why, right? Primarily two parts. One is if you see just purely from a first principle standpoint, the business and the business model and the country which we are in, it's a blessing that we are in a country like India. So from the parlance of, let's say, consumer and consumer demand. So the challenge is not to create a demand. So here the problem which we are here to solve is like how do you tap to the demand and service it in the most optimal way. So then if you leave the demand side aside, then the two other aspects is how do you actually operationalize it, which is, let's say, the product market fit, your serviceability, etc. That's where the digital players come in. And then the other aspect is how do you capitalize it or how the supply side is taken care of. And that's where the NBFC is coming. So the actually two sets is like the fintech players who are like primarily into the achieving the right product market fit and origination and again servicing, and the NBFCs coming in to make sure that there is the right level of capitalization. So that's the number one in terms of responding to why. The second part is, if you see in terms of the structuring, therefore it is a very symbiotic relationship. Pure play from a core competency standpoint, the digital players, digital entities, their core competencies like digital product, reachability, engineering, innovation, that's their core competency, alternate data, alternate underwriting. Whereas the core competency from an NBFC standpoint is again the capitalization and managing the assets. Beyond the core, the symbiotic core competencies and the symbiotic relationships is also the closeness in terms of the DNA. With all due respect, with some of the traditional large banks and financial institutions, their risk appetite and then the DNA orientation, it's a lot on the other side of the spectrum. Whereas if you see the NBFCs who have been at the forefront of financial inclusion as well as financial innovation, from a DNA perspective, the adjacency and proximity is also very close to the digital players. So therefore, in some ways, it's a perfect marriage when it comes to this kind of a relationship or propensity to, let's say, innovate or propensity to make sure the mandate of reachability, financial inclusion, and everything put together. So these are the two whys I would believe why it is so important, and it's a boon as well as a cornerstone for the NBFCs to really propel digital lending.
Okay, so it's a boon and it's as aggressively pushed by every lender. In fact, lending itself is a boon. That's why most of the fintechs are getting into this business as well. But let me share an interesting analogy here. I live in Mumbai and operate from a Kamala place, which is the most happening place, a party place in Lower Parel, and my office is in Times Star. So Thursday, Friday, you will see a lot of youngsters, going to the cafes, in the pubs and the clubs. So one fine day, I was having a meeting with over a nutritious drink with a banker, and we spoke about many things. When we came out, he saw the young generation, okay, going into the clubs, standing, waiting outside the pubs, and he says, "What is this?" I says, "Sir, you are the one who's financing them." And he's like, "How come?" I says, "Sir, this is BNPL." Everybody has an iPhone. Everybody has, the Ola, Uber at their call away and all that. So my question to you, with this background, Anil, since everybody has a access to loan now, everybody is actually find it very easy to borrow funds because of fintechs or NBFCs and hold the digital dynamics. How aggressively are we reaching to the geographies which we did not cover? How aggressively we are reaching to the borrowers which were not in the credit line earlier? And how aggressively we are actually building a strong book of credit with a new population?
Yeah, Amal, I think I'll slightly disagree on one point you just said, which is everybody has access to loan. No, it's only top 100 million people have access to a lot of credit in India. Once you go beyond the top 100 million, the rate at which the credit access falls is, I mean, exponential. Like it drops off. Like, and this is driven by multiple factors. One is if you look at customers with low incomes, when your income drops below 40,000 or 30,000, your ability to get credit dramatically drops. If you're not from the type of employment, if you're not from an employer who is a grade 1 employer, once more it drops. If you're not from a tier 1 or tier 2 city, once again your ability to get credit drops. And that's where I think players like us who are focused on digital lending, as Suparno kind of referred to, we are kind of bringing financial inclusion and financial innovation. And this is coming in terms of the kind of products we offered and the kind of, I mean, not just the products, but the way the products can be used. And also the aspects that relate to the credit underwriting and the ability to go and look beyond the fully credit served consumer. That's what has brought in a lot of innovation into the space. And even now, if you look at the customer service that is being serviced by even the digital lenders, we have gotten out to another 100 million people maybe. Whereas there are almost 700 million people formally and informally employed in India. And each one of them has an ability to get credit and service that credit. And unless we are tapping into that potential, we have still not being aggressive enough. So while there is a lot of untapped potential, the potential that has been tapped, or we are just barely scratching the surface of the iceberg. And there is a lot more down below there that we have to service. And a lot of us on this forum are trying to do that, and there is a lot more to be done.
Sure. So now I have another analogy. Though I belong to a millennial generation, I still find a major difference between Gen Zs, and many of them work with me in my office as well. Because they are borrowing for, not from my office, they're borrowing for anything and everything. And the great part here is I have seen lots of people, and this example I always give, has been borrowing even to go on a date because they want to look, really nice and they're serving their aspirations, right? Now, my question to you is, I know someone who borrowed because he wanted to attend a nice wedding. अब जब तक वो EMI दे रहा है जिसकी शादी थी उसका भी divorce हो गया. So now he thinks that, but he's still paying the EMI. So my question to you, Prashant, is how interesting, how unique this model is of creating an aspiration in the youngsters that you are offering them digital loan at the seamlessly. But on the other side, perhaps he bought it only because it was available and it was not needed. And it may be a big challenge for NBFCs and fintechs to recover it from him. So how do you see these both aspects? On one side, because the borrowers are there because it's easily available, and they may not, repay it as seamlessly as they received the loan.
So, so we are not a lender, so I'll have less perspective than the lender.
That's why I asked you actually.
So
the system
just to caveat what I'm going to say in general sense. I'm not taking a risk anywhere on this. See, but I think I don't know if majority, your analogy may be correct, but I don't think it applies to the majority of the people in that sense, in terms of how they're taking it. So, and I think all of these players, and increasingly when we work with our customers, like I was saying, these first time loans, let's say it's an NTC, or obviously you're looking at giving credit to these, the ticket sizes that are given to them are much smaller. No one is going out and handing out a large ticket unless, like he mentioned, you're in that 100 million and you're salaried and you're grade A and all of that. So, because beyond that, then someone will take a risk, on a small amount, and not that. So, and I think the way the underwriting models are evolving, given the data, the alternate data that's flowing into the ecosystem, how people are looking at all of these signals. I think he spoke about how collection efficiencies are improving given the digital strategies that they're employing for it. So I think it'll get better. Yes, we are not there yet. I think there's a long way to go, but it will get better the more we are able to harness the power of all of these elements from a data perspective. Of course, without being too intrusive, and the last thing I want is कि मैंने loan दिया and then 20 of my friends are getting a call saying कि भाई आपका बंदा पैसे नहीं दे रहा है. So without going to that extent, from a predatory perspective, I think, yeah, I mean, but that's what lending is, right? Taking that appropriate risk and trying to see where your cutoffs are and how do you balance that. So, yeah, I mean, I think there is a significant ground to be covered, but unless someone takes that risk and we further this ecosystem, we won't get ahead. So I think what they're doing is extremely relevant, and players like us who help them do a lot of that. All of us have a significant role to play in this, whether it's in decisioning, whether it's in collection, whether it's in monitoring. How do I measure that? And can we look at these early warning signals to be able to maybe stop something like this? So that's where we go.
Sure, Prashant. In fact, thanks for adding that. I wanted you to give a tech perspective, because I will also take the same question to Manish and add on the specifically recovery part. So obviously disbursal is very easy, seamless, underwriting process is easy. How is it when it comes to recovery? If you could give more sense on that.
See, I think most of the banks and NBFCs, which are run with good governance, have a good business model, right? So NPAs are controllable. That's why they are profitable. Now, I think leaving the judgment aside, whether how the person is actually going to use it is about building a credit score, right? So every individual has to go through that process of taking a loan, building a credit score. A few fail, most of them give it back. But I think the most important piece is the intent, right? And that is where most of the models focus on. So with lending card, we give MSME loans. We basically do credit underwriting. We use cash flow based underwriting. So, and we also give loans to thin file customers where they don't have a bureau score or things like that. And obviously the percentage of those segment is lesser in our book, but they perform better than our 700 CIBIL score. So I think what is really important is understanding those signals as to whether this customer has the right intent, whether this customer has the right behavior with this credit, whether this customer is responsible, and the social standing of that customer, right? And then you sort of take a risk on that customer, and obviously monitor the customer, make sure that the EMI is paid on time, warn the customer if required. But at the end of the day, I think economies are built with credit. Banks take credit, businesses take credit. Now it's time for individuals to sort of make sure that their aspirations are filled and they use it appropriately. And we are, again, as Anil was saying, we are just scratching the surface, right? So I think if we have to become a $6 trillion, $10 trillion economy, credit is one thing that, is the maker or breaker of where we had to go to.
Okay, sure, Manish. So, do you want to add in terms of what could be the right strategy maybe for NBFCs, fintechs, in terms of using the AI data far more aggressively, so that you have to do two things right? Obviously, not only just underwriting and disburse loans, but also recover aggressively, which could be an issue later on, right? So, what could be the right strategy here?
Yeah. Again, data is a core constituents. Like, so if I have to do some level of, let's say, analogy. It's like you have oil and then you have the refineries, right? Without the refineries, not much you can do with the oil. Obviously, you can mine the data, mine the oil and all. But then the data strategy is also a function of point in time in terms of how the evolution of the entire industry has been, more specifically for digital lending, and also a case in point in terms of the individual players. So if you see when, let's say, a digital lender is at the early stages, or overall the industry has been at the early stages, the focus around data strategy has been primarily how do you capitalize data for alternate modeling, how do you actually access to alternate data, so that you can build a core IP which is very unique to you, which is like maybe on the other side of the traditional way of doing it, which increase the serviceability of the market, your ability to underwrite. So that's the phase one. If you see in terms of the material players and the overall industry, we have moved ahead of phase one. Then comes the phase two, where individual players and the industry also has come to that stage where, let's say, as Manish mentioned, aspects of collections, aspects of origination. Then you look at the entire value chain and see like, okay, I have created verticalized out like very deep data in terms of creating IPs of underwriting, etc. But how do you look at the value chain and create an optimization strategy around data? Be it be origination, collections, operations, everything put together, even for your corporate functions. So that's the second phase and the second critical part of data strategy. Many of the players, given their stage of operations, possibly are at that stage. Overall, now what we are seeing in terms of data strategy as the ecosystem, digital lenders, be it in the PL space, be it be MSMEs, we are at the stage of being responsible players when it comes to data strategy, which means like taking a very holistic view and see like, okay, what it means from an information security standpoint, what it means from a privacy standpoint, and what it means not just from a regulatory aspect, but the trust which we build with the consumer and the customer. Amol, there has to be an acceptance that there is an element of trust deficit when it comes to the consumer and the digital lending industry still. And material players have to have that level of responsibility when it comes to data strategy to see like whether it's very, very holistic. They cannot afford to have a viewpoint of, okay, what I do with the data. If you see few months back, even the Honorable RBI Governor had a mention around it. Are you going to have a view around customer serviceability, or are you going to have a view around like, okay, what I do with the data? So it's a paradigm shift which all material players and the business and the ecosystem has to have. And again, I'm a Spider-Man fan, so I will tell that with power comes responsibility. So this is the phase in terms of data strategy, I will call it out, that take a holistic view and have a very, very responsible approach when it comes to that.
Sure, thanks. Thanks for adding that. Good highlights, must say that. So, ladies and gentlemen, I will come with few questions now. If you have any questions, please raise your hand and stick to your question. I will take your questions before I, shoot these questions to Manish and others. But please be ready with your specific questions. I will come to you very, very soon. So, Manish, we discussed, the how important the digital lending, whether digital lending is a boon or not, how important it is, what should be the strategy, and more importantly, how to cover recovery. How should we have a strategy for recovery? But when we look at the current situation where the regulator has been very, very active and it framed regulations specifically for the digital lendings, right? What kind of impact do you see going ahead? Do you see that the fintechs and NBFCs will disburse loans at the same speed which they had earlier? Or they will now go and evaluate customers far more aggressively, look at the risk management very aggressively, all the same partnerships, because ultimately the regulated entities will have a responsibility of LSPs, right? So how do you see the impact going ahead of those guidelines?
Yeah, so the digital lending guidelines, specifically that came out, right? I think they and various other, papers that RBI actually published. I think they highlighted about 3 or 4 extremely important things that I feel have given clarity to the entire end-to-end ecosystem. Maybe banks, maybe NBFCs, maybe fintechs, maybe technology companies or the last mile companies, right? But I think the 4 major categories that they covered was, customer ownership, which was, who owns the customer, and that is such an important clarity because what really happened was it was a hot potato, right? Everybody would move from one place to the other. So that clarity has given much more structure to how REs operate, much more structure to how LSPs operate, and the last mile people. I think the second piece that they gave clarity was customer grievance. Now, again, it was like a hot potato. Who owns it? Where did it come from? Who will it land? Which book did the customer land on? And I think that level of clarity, at least while we are dealing with our partners, our LSPs, has again simplified, what to expect from them. How do we monitor them? What is the data that we want from them, and who owns the data? I think that is also very, very important. I think the third piece that they gave clarity on was one was the customer. I think the third thing was about data localization, and that also has sort of defined who our third partners would be. Even if you're sort of using a CRM which is actually hosted outside, is this possible or not? So I think those are some very unifying mandates that were actually given by RBI. Initially, when it came out, to be very honest, right, we were also rattled. Oh my God, there's one more big thing we have to worry about. And I think the fourth one was about the transparency on the terms to the customers. How do you display an APR? What do you have to make sure? What are the hidden costs, and how do you actually make sure that those are actually displayed to the customer? So some very, very significant, actually simplifying, I would say, tenets that were actually released. And initially, we were actually taken aback, but once we released them, I think it's made doing business much more easier. So I don't see anything slowing down. Obviously, the credit risk, how we evaluate, there was no guidelines around that, and I think that is where the innovation happens. And then the innovation happens on how you're creating credit products. So as long as we are able to do that, I think we'll be able to sort of push it up.
Okay. Anil, do you want to add on that? Will it be tough for REs to manage LSPs, loan service providers, aggregators? Because ultimately, the REs will be responsible for all the loan disbursals or the customer acquisitions that LSPs do.
Yeah, I think first up, I think the digital lending guidelines have been a boon to our industry. One, we have started to become an industry of significance now. That RBI believes that it should be having its own regulatory structure, and having given out the guidelines, that has clarified a lot for the industry, right? Like now we are sitting here and very easily talking about REs, LSPs, DLAs. That taxonomy and that vocabulary didn't exist 6 months ago when RBI said the lender is always an RE and everyone is an LSP, and the app that you are using is a digital lending app. Now we use it as if it is second nature. But 6 months ago, everyone was a fintech, everyone was a lender, and you don't know who was regulated. So in a great, I think it has brought in a great amount of clarity to within the industry, and more important to the consumer. I think Manish already touched upon a few important factors, like they are talking about standardization, like disclosures like APR, transparency, making sure the customers understand the costs involved. So, and a lot of that responsibility, as you rightly said, has been put back on the RE, which actually holds the license, who are not just governed by the digital lending guidelines, but are also governed typically by the banking regulations or by the NBFC master directions. And it's not like none of these rules existed. They just clarified saying these rules have to be followed irrespective of whether you are giving the loan from sitting inside a branch or whether they are coming through an app. And when that clarification has been given, even the folks who were wanting to call themselves lenders previously are now afraid to call themselves lenders, because they want to say I'm a LSP only. Some people even want to say I'm a technical service provider, because the regulatory threshold is a little lesser if you're a technical service provider than a lending service provider. So I think it has been a very important development that put back the responsibility on where it rightly should be. The licensed regulated entity should always be responsible for the customer and to the regulator on behalf of the customer. So whether it's grievance redressal, whether all the aspects we talked, and also about data ownership or customer ownership clearly and without any doubt lie with the regulated entity, which makes it easy for the regulated entity also to manage the relationships. I mean, there are no more conversation when a fintech comes to us, and we are a fintech and an NBFC. That's what we always believed at FlexPay. But now when a fintech approaches us for a partnership, they are not talking about customer ownership, data ownership, or that if they're a lender, because previously everyone was thinking they were a lender. So it has rightly put back, and I think the REs already have the infrastructure. They have the compliance department, and now it's just about aligning them to this new digital world and making sure that you are following not just the master direction but also the digital lending guidelines. And it makes it easier for the regulator to oversee and monitor and make sure that the industry is sustainable, right? Like we all have agreed, it is a boon, and it is the main growth factor. And if you are unable to properly regulate and monitor it, then then it will not properly grow. And one of the biggest challenges we all had about 2 years ago was a lot of illegal lenders from one of our not so friendly neighbors who were all using a lot of coercive collection practices and charging higher rates probably, but most importantly not sticking to the principles of transparency. So we we have been able to overcome that, and now there is a clear framework that helps this industry grow and service newer segments that kind of fit in with the country's digital India view, which is focused on financial inclusion as we grow to be a $5 trillion or a $10 trillion economy.
Sure. Noted your points, and a quite meaningful one. Thanks, Manish and Anil, adding this point on regulatory aspects. Anybody has any questions specifically on the digital lending, please raise your hands. Can we have a mic on the first table here? Yeah, yes, go ahead.
And do you think that could be a potential threat for NBFCs? Because let's face it, right? The BPAs do belong to banks, and essentially, this kind of embedded credit is exactly what BNPL players were doing so far, and the regulator has taken that ability and given it to banks now. So, do you think that could be a threat for the digital lending strategy for NBFCs? And if so, how are you people looking at it?
Okay, interesting question. You should keep sharing such questions to us as well. Thank you. So I hope we copied that question. Manish, do you want to take it?
See, I think UPI is actually a protocol, right? So you have NEFT, you have IMPS, you have bank transfer, you have debit card, now is UPI. All of these protocols actually are sitting on top of one instrument, which is your bank account, right? So, but every time there was a new protocol that was built, the accessibility and the simplification, so the convenience of being able to access the instrument behind all these protocols becomes much more prevalent. So now UPI used to work on savings account, checking account, your normal account. Your ability to access credit on a UPI protocol, which has proved to be an extremely convenient way of transacting, is an absolute looking forward moment for us. So absolutely, the loans that we will disperse, we will try to figure out, how do we sort of enable UPI on that. Now, credit cards are also being enabled using UPI. So I think it's a watershed moment for our industry.
Sure. Thanks for answering that. I think that's going to be one of the biggest thing going ahead, right? NPCI is trying to be very active on that front. But I think the ticket size is going to be very small. But ultimately, the NBFCs, fintechs will partner, at the back end, right? They will process it. I think the bigger challenge will be with the credit cards than the fintech and NBFC. This is my view. I'm yet to study on that part. Any other question there? Yes, please go ahead.
Hi, this is Ashok from ICICI. Mr. Anil nicely explained about the DLG. It basically fixes the responsibility and weeds out the not so serious players. One more aspect of DLG was about the data access. it placed a lot of restrictions on what sort of access borrowers data access can LSPs and the RE take. So that seems to be much more restrictive, especially when you talk about instant loans. There is a lot of data which is collected based on which the credit decision is made. So as an impact of DLG, how would you see the ability to evaluate credit impacted by this guidelines?
Yeah, sure. So,
Yeah. So yeah, it's a fair question. As you've seen in the digital lending guideline, there are callouts and contours of what you can access and what you cannot access, agnostic of whether the customer is okay and consent and all. It's a good thing, and it had to happen. Because if you see from a consumer standpoint, with all due respect, let's face it and accept it, though the consent power was always with the consumer, not always that level of awareness maturity was available. And more importantly, as something which even Anil alluded to, there was you cannot really qualify the long tail of the players to be very, very responsible. Now it is a good thing which has happened with the contours being fixed, that the material players, the regulated players, they all have the same level of boundary and contours. So therefore, in terms of accessing what you have as a non-financial asset in terms of the data, it's a level playing field. What you do with it, how you refine it, and how you optimize to the next level and do underwriting, that's the differentiator. So the play is not to access data which is not required or which can have a sense of misuse, but the play here is like, okay, these are the contours. Now how well you play, more than the what part of it, the how has gotten amplified. Does that have an impact on how, let's say, the responsible players have been doing underwriting? The answer is overwhelming no, and in some parts possibly yes. Maybe some of the players were accessing a contact list. Now that is stopped. It's a good thing, because if you talk to them, what's going to happen is the contact list was being misused by a long tail of players who was bringing in possibly a bad repute to the entire industry. So it is a very, very important decision or important part of the digital lending guideline to be able to separate the lemons out. It is not going to have an impact on the ability to do underwriting. All the more it will push and challenge to do the underwriting in a way in terms of alternate model, rather than trying to think, okay, what data you can use. And more importantly, the contours that the regulators have put, you will see they were not primary data points and parameters for underwriting, but they were mainly used for unfair means of collections and recovery. So that way it is not a major impact.
And I just wanted to add to that, because as a tech player, we did see some impact, but there was very quick architecturally reorchestration of these flows to ensure that that impact was very minimal. So, because as a tech player, while I can perhaps see the data, because I'll have a one-on-one relationship, let's say, with a lending card, and so if you as a customer come there, they may use me as a TSP to be able to process something, look at, let's say, a certain scorecard. But if you as a same customer goes to them, I might have to rerun all of that again and not just necessarily use any intelligence that I had basis here. So we've seen financial institutions and regulated entities, and they put a lot of pressure on someone who's a tech player to say, you have to come back with sub-second responses or whatever that is. So it pushes the boundary of innovation in that sense. And having seen this over the last 6 to 8 months, I don't think it has necessarily made such a big impact from a decisioning or a time to decision perspective. And of course, the benefits of saying who owns the data, are there walls between how this data is segregated and then used, I think has gone a long way in safeguarding our own interest from that perspective, from a data perspective. So,
if I may quickly add one point. See, what the digital lending guidelines have done is clarified the ownership, and the owner of data is neither the RE nor the LSP, it is the customer. The customer is giving you consent. And the most important aspect in India with respect to innovation on credit underwriting, our regulator-driven and government-driven interfaces and infrastructure, especially with folks like, with concepts like account aggregator, we are about to get to access to a lot of data in real time, tax data, bank data, which was not available very easily. And even today, if you look at other countries in the world where it is not at all available easily or difficult. So with the account aggregator framework, we will have such a wealth of data, both tax and bank data, that we should be able to use more creatively for underwriting. That any personal data on whether the customer what apps what apps a person is using to do underwriting may or may not be as relevant as a tax data or a bank data.
Okay, sure. Any other question do we have? Yes, can we have a mic there?
Hi, I'm Usha Ramesh Kumar. I want to know what is the impact of digital lending in rural areas? India is mostly rural. And do you have an impact, or do you expect you will make big impact of digital lending in the rural areas? Thank you.
You want to take that?
Yeah,
Swapnil?
sure. So, ma'am, thank you for asking that question, because we call it out like the mandate of financial inclusion and how digital lending is playing a key role. Just to give you some facts and key statements, overall, the industry currently, if you look at it, at least I can comment on the PL space, overwhelming 55 to 60% of the lending is happening in tier 2 plus. We as a player, as True Balance, we do more than 65 percentage plus in tier 2 plus areas. So if you see from that aspect in terms of reachability, inclusion, and being able to underwrite both in terms of accessibility and availability to those areas, it's been really, really at the forefront. I must also call out, it's not just about the rural reachability, but thanks to some of the alternate ways of underwriting, you will see in such cohorts of customers, they are not always having, let's say, a long history of a bank statement or certain documentation, which is obviously the compliance is the lowest common denominator, but beyond that, they don't have many at times. Therefore, the alternate ability to underwrite them also has been a big boon, and the digital lenders have played this key role. And this is the stats and data for the industry and all significant players.
Yeah, sure. Why not?
So, just to answer that question, right? So overall, I think digital, as everybody's lending guidelines have clarified. Overall, for lending card, we again give MSME loans. 60% plus of our book and lending is done to tier 3 plus, right? So, and post digital guidelines, we haven't seen, obviously the growth has been constant and we've not seen any impact because of that. So, very specifically to answer your question.
Yeah, sure. Any last question before I move on to my questions? Yes, please, go ahead. Can we have a mic there?
Yeah.
Hi, Jiten here from Cash-Free Payments. So since we are from a payment gateway, right, just wanted to touch upon one point in the digital lending guideline, specifically mentioned about the fund flow also. So the LSPs which were actually pooling the funds in their account earlier on, the guidelines, the DLG guidelines and the subsequent FAQs mentioned that the LSP shouldn't have a direct or indirect control on the fund flow. So effectively making most of them as a DSI instead of an LSP. So how important do you think is a payment aggregator or a payment infrastructure when it comes to the LSPs in the after the DLG guidelines?
I somehow couldn't catch your question.
I think
Anil, did you?
Yeah, I think you are specifically asking about fund pooling by
Correct,
LSPs
yeah.
on behalf of the regulated entities.
Yeah.
Within the digital lending guidelines that has been
Yeah.
now not allowed.
Yeah, and also the clause which says that the LSP shouldn't have a direct or indirect control over the fund flow. So
Yeah.
both the aspects, how do you think a payment infra player can help in basically tackling that?
I think, I mean, the digital lending rules have been in effect since November 30th. And anyone who was affected by those specific clauses within the rule has already adjusted their business models, some of which might also be legal questions. So I don't want to kind of sit out and act like a lawyer here. So, but I think there has been some impact, but there have been solutions already in place. And some of these are provided by the payment services providers themselves. But once more, the regulator is clear that the licensed entity, which is a regulated entity, should also be the one which is directly collecting funds or disbursing funds to the customer. So to that extent, everyone has to evolve their business model around the rules, and rightly so.
Okay, sure. So I will take last question with all of you now, and Prashant, I will start with you. considering the major changes, the fintechs are going to be perhaps regulated, if not directly by RBI, the REs. The NBFCs will also be very aggressive in terms of developing new technologies. How do you see the role of a tech player going to be and going to be in terms of changing every day, evolving every day, in terms of supporting the digital lending, maybe in next 2 to 3 years?
Yeah, so while a lot of their focus obviously is tech-led lending, but they have to pay a lot of importance to, let's say, their own underwriting models, the compliance requirements, and so we as a tech player help them with the entire ecosystem of whether it's plugging into the account aggregator framework, or helping now there's ONDC, which is going to generate a large amount of data, which I think will be very useful in embedded finance and in those kind of models that will come through. So as a player, we see ourselves very strongly supporting this entire ecosystem and helping them basically time to market really quickly, right? Because they'll have innovative products, they'll come up with innovative models to underwrite basis some of this data that will evolve through the digital ecosystem to be able to take decisions in real time or in near real time. And I think that's the role that we increasingly see from an engineering and a platform engineering perspective and a scoring perspective, to be able to support all of them in achieving their digital-led lending models, which will largely be underwritten basis the data now that is going to flow through these frameworks. And I think to Manish's point, see, someone would take a bank statement once, and there was a lot of friction which we've simplified. But now in the account aggregator-led system, you could technically pull a bank statement every month. And so your ability to be able to monitor and to look for signals in that stream of data that flows, I think that whole measure and then monitor approach is going to kick in significantly as data becomes available on these ecosystems, and then with the newer models of embedded finance coming because of ONDC and all that. So it's an exciting time for tech players like us to be able to support the digital lenders and the new age NBFCs, expand the horizon of lending into tier 2, tier 3, tier 4, because consumption, actually real e-commerce consumption is also increasing there significantly, which will lead to a lot of models on that.
How do you see, so the next question to you before I hit to Manish and Anil. How do you see the evolution of digital lending in terms of your own ways from your company perspective? What kind of changes do you see happening, and how are you going to get ready for it?
Yeah. So if you see from the change perspective, right, and if you have to have a horizon of, let's say, 36 months and beyond kind of a frame, there will be obviously a lot of appetite and there is a lot of headroom in terms of growth, but the growth will be more in terms of sustainable growth. We have come out of that phrase overall, possibly as an industry and even as a player, where it is about like the initial stages and it's a first scale of a hyper growth. The change is going to be more of a sustainable growth. So you will see there is a evolution in terms of the ecosystem. So one side of it, as was mentioned, right, engineering will be core. The engineering part of it will keep creating the differentiator part of it. But when it comes to sustainable growth, the ecosystem play is going to be more there. The keyword is going to be collaboration. As of now, the keyword has been more in terms of being a creator. What is that you're creating in terms of an underwriting model? What is that you're creating in terms of, let's say, a product? The creator phase is gone. And from here on, it's more about like how well you collaborate for a sustainable growth. So that's going to be the key, which means like, again, NBFCs, digital players, LSPs, regulators being able to co-create products, sandboxes, the further evolution of the India stack. We mentioned about account aggregators. So just joining the dots, the players who are going to collaborate the best, they're going to be the winners. And that's for the well-being of the consumer as well.
Okay, noted your point. So, Anil, Manish, both the gentlemen spoke about different sustainable growth and how the tech will evolve. My question to you in terms of how the business model will specifically shape up going ahead, because a lot has happened in the digital lending space. So, going ahead, will you be far more, far more specific in terms of whom are you lending to, rather than perhaps lending to a Gen Z who's going for a party? and look at the data very aggressively? Will you do a cash flow based lending, data based lending? How do you see the whole lending business model is going to shape up? Because after the 4 5 years, of fintech operating in this space, now the major growth is sustainability, profitability, maintaining the margins, right? So how do you see the whole structure? This is a very broad question because you're operating in various segments, and same is with you. So I want your views on this aspect. How do you see the whole arena in next 2 to 3 years? Manish, I will start with you, and then Anil, you can add.
So I think banks, right? So banks actually have built a very horizontal infrastructure. So they have branches, they have reach when it comes to actually accessing. Jandan Yojana actually opened up the venue for them. Now, where do NBFCs and fintechs come in? NBFCs and fintechs play on a mainly on a vertical segment, right? Where they specialize, say, on transportation, on MSMEs, on personal loans, on segments, on industries. So I think there is generalization, then there is specialization, and I think overall as an ecosystem, the way we are evolving, and even the tech players, right? There has to be a lot of collaboration because there is so much to do, right? So you can't be a jack of all and master of none, right? So you have to master in segments. So I think specialization, and if you're building your model on specializations, and then you've seen various startups actually evolve, right? So they specialize and go deep in one segment, and then adjacent businesses sort of evolve around it. So I think when you're talking about business models, I feel going deep, especially for NBFCs and banks, and then specializing on a particular segment, on a particular structure, on a particular segment will be extremely important. I think the other thing, with a lot of different ecosystems, infrastructure being built, the access to data is going to be there, right? So obviously, customer data is private, customer data is personal, but with consent, that data is portable now. Now, with portability, what's really happened is data is not the oil anymore, right? It's not, where, stored energy, where, when you burn oil, you'll get energy, right? It's always on the move. So it is now become the electricity, right? And with electricity means data is always on the move. You always have other sources of data that are coming in. You have always other signals that are coming in. So the models and businesses who actually build their processes around these signals and ability to consume this data and build models on top are going to be, I think, the future.
Sure.
And I just wanted to add one point because I think what he said was so important. This vertical specialization that an NBFC brings, and we're working on this really exciting project. And one of the asks there is to create this marketplace for green finance, which is electric vehicles, and they want to fund the entire ecosystem, right from the battery makers, the component makers, and for aggregators who have fleets of vehicles to finance electric vehicles. And there they've identified about 5 or 6 NBFCs that really just want to focus on this particular niche vertical, as he said, work with the OEMs like Ola and all of the other electric vehicles, get that vehicle data as well to evolve the underwriting models. So to his point, it's very targeted, development institutions working towards green finance and again tech, data, specialization in terms of the product itself. And I think that's where NBFCs actually play a fantastic role, is in pushing this innovation and this vertical specialization for new products and segments. So,
sure. Anil?
Yeah, I think already Prashant, Manish, and Suparna have spoken a lot about how they see this business evolving. So, just adding on to that, in terms of business model, if you are focused on where the established players, the banks and the larger NBFCs are already servicing, then your growth can get stunted, right? So if you're focused on financial inclusion and serving markets and servicing customers that are today underserved or unserved, that's where the business will move to, and that's where the growth is there, and that's where there is less competition. And so that will be the broader theme, I think, as people will, as companies evolve, within digital lending to move from the top 100 million to the next 400 million. And the other thing that I want to kind of emphasize on, we as a country have done such a fantastic job building up public infrastructure. The next phase of public infrastructure we are building are what Prashant referred to as ONDC, but the other one is OCEN, the Open Credit Enablement Network. So these will now become the drivers for the next phase of lending, digital lending growth. And Manish very eloquently put that data is the new electricity, and that electricity is being powered by our government and our regulatory agencies in providing us with this infrastructure, that companies that are able to latch onto this and leverage this and evolve business models and products that fit these consumers who are expected to be on this public infrastructure will form the next phase of growth, just like UPI was to payments, ONDC and OCEN could be to lending.
Right, absolutely right, Anil, and that's come to an end to this panel discussion. I think it was an enriching experience for me for listening to various layers. Thank you so much for unleashing the potential of digital lending as introducing us to a future. In fact, what may happen in next 2 to 3 years. And ladies and gentlemen, thank you once again for listening to us very patiently. Stay back with us and attend, I think, 2 more sessions which are left post lunch. And just one small request, please feel free to share your feedback, suggestions on social media. Do follow us, because in the world of social media, digital media, it's very important for us, to share our learnings. That's where we get our page views, likes, and that's very important for us. So please feel free to share your thoughts, and any particular aspect of any speaker that you like, please tag us and share your views. Thank you so much for listening to us very patiently, and we'll meet after the lunch. Thank you.